The health savings account, also known as an HSA. Many of you have heard of this. Many of you may even have this type of account, but I want to explain today how can you utilize this as part of your broader financial plan. I find that this is often mismanaged or maybe at worst just forgotten altogether. Stick around, I'll show you how to utilize this to maximize its efficiency. Hey everybody, I've got another video for us today. Today's topic is particularly helpful, I think, for healthcare professionals, but not just only healthcare professionals, but anybody. And the topic of today's conversation is the health savings account, or oftenly known as the HSA. So, like I said, I think this is really helpful as you're starting out, especially if you're a physical therapist or another healthcare professional. Chances are you're in relatively good health, and I want to explain some nuances of this type of account and show you how to get the best out of it over time. So I'm going to break this down. In a lot of this video, I'm going to just highlight some things in Excel to give you some information that I think will be really helpful. So let me back up real quick and just explain what is the health savings account. So the health savings account is an account that you can open with different providers. There's several out there that are national providers of HSAs. And you're only eligible for this type of account if you have what's called a high deductible health plan. And when you go to sign up for your benefits, you will see in the benefit packet, it will say HSA eligible next to the plan that you sign up for. If you're in a high deductible health plan, you can contribute to this type of account. So why is this type of account important? What is it really used for? So it's an account that you own and it's portable. So if you take this account and you open it when you have a high deductible health plan under one employer, you can actually leave that job and all the money that is in that account goes with you. Again, it's established not through your employer, but you have access to it because you're part of a high deductible health plan, which usually is offered through the company. So, for example, just to name a couple big names, one would be HSA Bank, another would be Health Equity. These are companies where you could house your HSA account. So the great thing about an HSA account is it's what's called triple tax advantaged, because a lot of times you can contribute to this just like you would a traditional another pre-tax election on your pay. So money would come out pre-tax. The money that you put in an HSA every year is deductible in the same way that a traditional IRA would be deductible. So that's one of the tax advantages. It grows tax free, and if it's used for qualified medical expenses, it's actually distributed tax free. That's where we get the triple tax advantage from. Now, here's where the HSA really stands out. The HSA, unlike another savings account or banking account, can actually be invested. So most people, what they do is they look at their deductible amount and they put money in their HSA to cover that amount, but they usually don't go above that because they end up spending it in the year that the expenses occurred. So, for example, let's just say you have a $5,000 deductible. You put $5,000 in your HSA, you get to deduct it on your taxes, but then maybe you spend $3,000 that year on healthcare. That means, the end of the year, you only have about $2,000 left. That's great, but you missed out on, and then that other 2,000 is just sitting there in the not earning any interest. So one thing that most people do not do, but I highly recommend, is that you should invest your HSA. This is particularly helpful if you're on the high income side. So if your marginal tax bracket is high. The reason that's important is because you probably have a lot of discretionary income, and you can load up the HSA. For example, for a family in 2024, you can put up to $8,300 per year in this account. That's actually more than you could put in a traditional or a Roth IRA. So it has great tax advantages there. The other thing that's helpful for you as a potentially high earning professional would be you can pay out of pocket for your medical expenses. So let me give you an example. You are relatively young, maybe you're in your early 30s, maybe 40s, and you're still extremely healthy. You pay for your high deductible health plan, which is probably a low amount per month. The deductible is high, but if you don't incur many expenses throughout the year, my advice to you would be to pay with those expenses from your regular checking or credit card or whatever you want to do. Keep a receipt of those expenditures and actually invest the money that you place in your HSA. So what I'm going to show you here is I'm going to share my screen and I'm going to go through an example of why should you invest in your HSA. All right, so what you're looking at here is you're going to see, and I'm going to zoom in here. You're going to see an example over the course of 20 years, basically. Let me zoom out for a second. Yeah, that's too much. All right, so over the course of 20 years, you're going to see these HSA values grow. And what I want to draw your attention to is that from 2024 to 2044, we're assuming that you put the maximum amount. So I'm just going to highlight the column as I talk about it. So this is your yearly contribution column. So this assumes you start from zero, and in 2024 you put in, as a family, you put $8,300 in your account. This next column is going to be what is the total running total before we factor in any investment returns or losses. This column is the investment return, and that is actually based off of column B, which I just created a random number generator so you can see your rates of return are different every year. Now, this also assumes that you invest this fairly aggressively. This random generator ended up being somewhere around 6% over the long term, so I think that's reasonable for most people. And so what you see here is we take the initial amount, we take the investment gain or loss, and this is your year-end value. And we just repeated that process for 20 years. This also assumes that the allowable contributions amounts increase by 2.5% per year. So that's where 8,300 goes to 8,500. And the reason that I came up with that is over the last 20 years, from 2004 to 2024, that's about the average rate that has occurred in terms of the IRS limits that allow you to put that money in the HSA. It's going to fluctuate per year, but we have to guess for this example. So this person literally started at 2024. I'm going to assume that their age in 2024 is 45. So this assumes that you start at age 45. This example only gets better. If you're a 20-year-old listening to this, if you're a 25-year-old, this example looks even better for you. So I'm just assuming this person starts a little bit later. The reason I did that is I want to take them up to retirement over a 20-year period and show you kind of how this account grows and how it could be used. So think about this. You start out at 8,300, assuming these investment returns, again, some are negative, some are highly positive. There's everything in here. So this is a very realistic scenario. You're going to grow this amount. This also assumes you don't spend any of this money. So again, this is the strategy that I would recommend, especially if you have discretionary income. Pay out of pocket for your medical expenses, invest, if not all of your HSA, everything over your deductible. In this case, I'm just assuming they invest it all. Okay. So basically, when you get to the end of a 20-year period, this person is now 65 years old. They've put in $225,000, but because of investment growth, they now have $309,000. And basically, what I want to show you here is that $309,000 in 2044, when you're age 65, is very because of inflation, it's not as much as it is today. So one thing that a lot of people do when they think of an HSA is they think it's an alternative way to fund healthcare in retirement. So now I want to shift to a slightly different conversation, but it still involves the HSA, and that is long-term care costs. So right now, long-term care costs are going to average, and this is as of 2024, somewhere around 70,000 or so dollars a year just to be in a long-term care facility. And that would not be the top line. I'm giving you more of a medium or low medium number. So basically, in 2024, if we inflate that, I took 70,000 and I just inflated it by 3.5% per year. That puts the average long-term care annual stay at about 139,000. If we look at the research, what is the average time that someone actually stays in a long-term care facility? It's somewhere around 2.5 years. So basically, your total cost is about 348,000. That's if you were to do that at age 65. Good news is most people are not going to need long-term care at age 65. So what I did was I inflated this even further. I took our starting number of 139,000. I inflated that at 3.5% from age 65 to 85, which is much more realistic. And if you had to have long-term care when you're 85, the average number in today's or in tomorrow's dollars would be about 277,000. So if you take 2.5 years at that number, that means you need about 692,000. Now you can see why all those years of what you did in the HSA can really pay off. And here's what's really cool. So now I'm going to take that knowledge that I just explained to you about long-term care and about HSA and how it works, and I want to explain a couple more rules. So, one rule being, if you hit age 65, your HSA essentially turns into another traditional IRA. What do I mean by that? What that means is the money that you take out of that account at or after age 65 can be used for any reason, not just medical care, but you're going to have to pay ordinary income tax on that. So that's exactly how a traditional IRA works. Now, why do I bring that up? So, if you get to age 65, you probably don't need long-term care. You have a lot of money saved in this HSA. This is that 309,000 value that's up here. So, I'm assuming you can invest that at a conservative rate of return of 5%. And if you were to do that over the next 20 years, um, you can you can increase that value, but there's more. So remember what I just said, you can turn this into um, an additional stream of income in retirement and still pay your long-term care in the event that it happens. What do I mean by that? So what I did here is I just assumed a 2% withdrawal rate, meaning you're going to take 2% of that 309,000 value and you're going to actually live off of that monthly. So you're going to supplement what you take out of your other retirement accounts. So you actually just supplemented your retirement just by saving in an HSA and being smart. Now, that being said, if you take 2% out and you earn 5, your real return is close to 3. So what I did was I compounded this $309,000 at a 3% rate over until age 65. So you can have your cake and eat it too, essentially. What you're doing is you're actually living off some money per month to supplement your other retirement, and you're still ensuring you never have to draw down any of your other assets in the event that you become eligible for long-term care or you need that. So it doesn't quite get you there, but I just want to give you an example. So at age 85, instead of that full 692, even if you take some money out during the time and you don't even and you're not just fully investing in it all, you can still cover about 80 or 81% of your long-term care costs. That's really encouraging. So I give you this example to say, again, if you're 20, 25, 30 years old watching this, your example only looks better. That withdrawal rate in retirement is probably a lot higher, and you could still have a significant cost covered by this account. Even at 45, there's still a great chance that you can really offset some of these costs. Now, there's one other benefit to the HSA that I want to really highlight in this video, and that is tax-free. Okay, so I already said you have to pay income tax. So what do you mean by tax-free? Here's what I mean. So over the course of the 20 years from age 45 to 65, you still incurred some expenses. So that's column J. So when you're 45, you had to go to the doctor and have a small procedure, whatever it is, and you spent $1,500 that year. Well, great. So what we're going to do is every year, those are just going to inflate by, I had them inflate by 3%. So this column is going to inflate every year. You can see it goes up by 3%. I just added up all of that, okay, over time to say, And again, this is a conservative, right? When we get older, sometimes things happen. We have family, we have kids that need medical care, you have braces, you have all kinds of things that are considered medical expenses. So again, this is a conservative estimate, and I still got over $40,000. Now, why did I do that? Here's why I did it. It's because there is no time limit on reimbursing yourself for medical expenses that occurred while you were covered with a high deductible health plan and you had an HSA. So let me explain. All these years, you had your HSA growing in the background, which is here, but you also incurred these expenses. So what you can do is, let's just say, I'm just going to give an example. Here's another cool thing that you could do. I'm just going to write new car right here. Okay. And then I'm just going to say 25,000. All right. So at year 2041, something really happened. You kind of fell into a cash crunch and you really need a new car. Well, guess what? If you add up all these expenses, I'm just going to show this to you. If we just add these up, well, guess what? You have $32,000 of tax-free money that could be used because you have your receipts. So what this would look like would be you keep your receipts in the year the expense occurred. Keep your receipts that prove that you spent 1,500 on healthcare. Keep your receipts that you um, expended exactly these amounts. And then you get to this year, 2041, you really need that new car. What you do is your HSA account at this point has $275,000 in it. You could easily just either write yourself a check or do a debit transaction and pay for that car outright. When you report it on your taxes, you would say this was an expenditure for medical reasons. Now, it's not in the year that it was made, but you have the proof that you can reimburse yourself in that year for previous expenses. So that is a nuanced rule of an HSA that most people just don't know. So as long as that tax-free amount, meaning the amount that you actually spend it on healthcare, you can reimburse yourself at a later date. This is a huge, huge advantage. So I wanted you to see that because that is also running in the background of this as well. So this first spreadsheet does not take into account the tax-free portion, but it's always there. So meaning as long as you're spending money on healthcare in each of these years, every amount that you have, that's considered your basis, meaning this is how much I put in to pay for healthcare. You can reimburse yourself up to that amount at any time. So I hope you found this helpful. It is a really powerful type of an account, and I think it's one especially that you should consider given the fact that you have more time. So like I said before, multiple times in this video, the more time you have, the better this strategy works. Please comment if you have questions, comment if this was helpful. I look forward to bringing you more interesting content and things that you find educational and beneficial as you look to increase your own wealth and look to be on great financial footing. So till next time, see ya.